In the alternate version of exercise 8-5, we're going to continue on with our Ramirez Company example, but instead of recording depreciation using straight line, we're going to record depreciation using units of production. So it'll start out very similar in that we take cost minus salvage value, which if you recall is depreciable cost, and divide it by an estimated useful life. In straight line, estimated useful life was judged in years, for example, 10 years. In units of production, it's not judged in the length of time, but how many units we anticipate can be produced with this particular item. So, again, starting out similar, cost minus salvage value, cost of $85,600 minus salvage value of $12,100, but instead of dividing by 10 years, instead we divide it by 274,000 units we estimate we can produce with this machine. So depreciable cost of $73,500, which is just $85,600 cost minus $12,100 in salvage value, divided by an estimated useful life in units of 274,000 means we have an approximated estimated 27 cents per unit. So this is going to be a consistent or constant amount of depreciation expense that we're going to record per unit. So this company produces 1 unit in that year, they're going to charge depreciation expense of 27 cents. They produce 2 units, 2 times 27 cents, they're going to record depreciation expense of 54 cents per unit. So in straight line, we recorded a total depreciation expense. Again, key there is total depreciation expense per year, the same. Every year was the same. This one, it's not the total depreciation expense that's going to stay the same. Instead, we're going to record an equal amount of depreciation expense per unit each year of that asset's useful life. Again, per unit is the key here. So how do we figure out how much depreciation expense in total, not just per unit, but in total to record for the year? We simply have to look at what's the actual amount of usage that happened. This is the second year. The actual amount of usage is 26,100 units were produced. So to figure out the total depreciation expense in year 2, we take 26,100 units produced times 27 cents per unit, and we get a total of $7,047 that would be recorded as depreciation expense for the year. And we looked at journal entry, debit depreciation expense for $7,047, credit accumulated depreciation for $7,047. Now, compared units of production compared to straight line method is going to be used less. So less companies use units of production method. And that's not because it's inaccurate. The reality is units of production actually creates a much more accurate, in many situations, and not all, but in many situations, it actually creates a more accurate depreciation expense, particularly in situations where you're not actually using the item equally over time. So think about it. A vehicle, let's use a vehicle for example. If you're like me and you have a pretty constant route on a day-to-day basis of work and different activities, your amount of miles driven for your vehicle is pretty much the same. So if I want to depreciate my vehicle on a personal level, I can use straight line and just, whatever it might be, 5 years, 10 years, whatever I expect, because my usage is pretty constant. But some of you probably don't drive a constant route. Maybe you have a sales position and your clients are different. They're in different areas of Indiana or Kentucky, maybe in different states. And so the amount of mileage you put on your vehicle is very inconsistent from period to period. And maybe beyond even your business use, you have personal trips that vary widely of how far you drive. In that case, straight line isn't going to produce the most accurate matching of expense against the benefits that that vehicle brings to you. In that case, you're probably going to want to use units of production because that is more accurately going to record depreciation according to your actual usage. So again, units of production is typically more accurate than straight line, but it's going to be less frequently used. The reason being is that it's more difficult. It's a lot more difficult to estimate, how many units do you think we're going to get out of this? How many miles do we think we're going to drive this vehicle? And then track that actual usage of units or track that actual amount of mileage. That's a lot more work. So if a company, though, doesn't equally use, there's a huge difference of their usage, they might go to that extra work in order to get that more accurate depreciation expense or matching of expense against the revenue it helps earn. But if they've got other priorities or they fairly equally use that unit, then they're just going to stick with just recording straight line because it's a lot easier and a lot less costly.